Okay. Andrew. are the exams looking so far?
I've only graded like 5 of them, so I can't really say. I haven't done by Thursday, but I just started like 20 minutes ago. So.
That's great, but something if everybody's doing good or not good. Or...
It's a little bit too early to say. Yeah. And we'll talk about it Thursday. All right, it's 1 o'clock. Let's go ahead and get started. Good afternoon, everyone. How's everyone doing today? Doing good after the midterm. So hopefully everyone's feeling okay after that. So I've just started grading them. So I've only graded about 5 of them. So I don't have them ready for you today, but I will have them graded by Thursday. So that's what I'm hoping for. It's a little bit too early for me to comment on anything. So I think I'll wait till they're all graded on Thursday and then talk about it. About that. Okay. All right. And so this week we're starting a new topic. And so I think starting today, I think the economic portion of this class will take a bit of a turn. And so this is when things get to be, just from past experience, get to be a little bit more complicated than what we've done up to this point. Especially this particular unit on taxes. And so taxes, I think, is something that everyone has experienced and really kind of knows about. But once you get into the nitty gritty of actually computing it, it gets to be a little bit intense. And so, I do want to kind of warn you a bit ahead of time, before we kind of really get into it. Okay. All right. And so, for now, what I'm focused on mostly is just getting your exams graded. And so I don't have your next homework ready yet. But I think you can probably look forward to getting your next homework ready by Friday. Okay. So I'll have exam graded by Thursday, and then homework 4 will be ready for you guys to start working on Friday. Okay. All right, and so that's all my announcements. So are there any questions I can answer before we get started? Okay. All right, so let's go ahead and get started. And the topic for this week is taxes and depreciation. All right. All right, so up to this point, we've covered, what I consider to be kind of the basics of economic analysis. So we've covered how to do cash flow conversions, and we kind of use those cash flow conversions to do some kind of simple analysis. So we've done present worth analysis, annual cash flow analysis, and rate of return. So if you remember, rate of return is kind of the thing we did kind of right before the exam. Okay. Okay. So we've covered the basics, but if you remember, from early on when we were discussing a lot of these techniques, we had to make a lot of assumptions in order to make our calculations a lot cleaner. Okay, and so starting this week and over the next few weeks, we're going to be lifting a lot of those assumptions and seeing what kind of impact that has on our results. Okay. So we're starting with a pretty big one. And so I'd say this is probably the assumption that makes the biggest difference, at least in terms of like the raw numbers that you compute, and that's taxes. Okay. And so, I think, whenever you say taxes, everyone is like, they kind of groan, because taxes is something that you have to pay. In addition to that, you go out to eat, you see a price on the menu, but then you have to calculate in your head like an additional 10% for taxes. And so, something that not everyone likes to do. And then when you're working, you know, and you get your paycheck, you see the government takes a big chunk of that paycheck away because for taxes. So, you know, I don't think anyone really is a fan of taxes, but I will say that after I started working this job, I'm a little bit, my opinion of taxes is a little bit better because I know that it pays my salary. So, you know, I said, you know, maybe tax is not so bad. It's paying for paying for my salary. Okay. All right. And so specifically the taxes that we're going to be focusing on, at least, you know, the ones that's most relevant for an engineering company are income taxes. Okay. And so the idea with income taxes is that, you know, whenever anyone earns money, and, you know, and we'll consider an engineering company to be our entity here, you know, whenever an engineering company makes money through revenue or through sales, they have to pay a portion of that to the government as taxes. Okay. Okay. Right. So in theory, you know, taxes are a simple concept. And so you basically take the amount of money that you earn, you multiply it by a certain percentage, and then that's the amount that you pay to, you know, to the government. Okay. But there's a lot of other rules that are associated with this because there's, you know, a lot of ways that companies and individuals too can reduce the amount of taxes that they get paid. Okay. Okay. And so that process that we go through to reduce our taxable income is called deducting. So I think that's one of the more common terms for it. You might also hear the term expensing. And so basically the idea is that you know, you can reduce the amount that the government is going to charge you for taxes. Okay. And so that's the idea. Okay. And everyone does this to a degree. So, you know, whether, you know, you work for a company and you might have some money taken out from your paycheck before you pay taxes. And so a lot of people call those like pre-tax deductions. And so that's basically the same idea. It's just that for engineering companies, they have a little bit more avenues that they can use to perform these pre-tax deductions. Okay. Okay, and so the first part of the lecture today, we're going to talk about, you know, how do you actually compute taxable income? Okay. And so for companies that operate in the U.S., you know, we can compute how much money that they're going to get taxed on using the following equation. Okay. And so the first thing that you start with is the gross income. Okay. So the gross income is just the raw amount of money the company made through sales or through revenue. Okay. And so that's, you know, before any taxes are done. So that's just the raw amount of money that they've made that year. Okay. Okay. And then from this, we can subtract two main categories of deductions. Okay. And so the first category is called ordinary or necessary expenditures. And so ordinary or necessary expenditures, these are kind of the day-to-day costs that are needed to run your business. Okay? And so basically what the US government says is that, for any amount of money that you use to just run your business on a day-to-day basis, whether this be paying salary for your employees or purchasing raw materials, okay? Anything that's considered day-to-day, you don't have to pay taxes on those things. Okay. And so we're going to subtract that. Okay. And then the other thing we're going to subtract here is something called depreciation. Okay. Okay. And so what depreciation charges are is that these are the costs of any kind of large capital equipment or any large purchases that the company made that don't kind of lose their value, immediately. Okay. Okay. So kind of a big box right here, just because I tried to squeeze in the definitions along with the formula. But basically, the formula is just you take your gross income, you subtract out your ordinary/necessary expenditures, and you subtract out the depreciation charges, and then that's how you get taxable income. Okay. All right, and so today, the focus of today is going to be mostly on depreciation, but we'll kind of cover that in the second half of today. And so, I know the definition for depreciation is a little bit vague at this point, but, we're going to spend today talking about that. But for now, I think this is just a good for you to understand that, companies don't get taxed on every single dollar that they make. The first thing that they have to do is just subtract out, their operating costs as well as depreciation charges. And then whatever is remaining, that's what you get taxed on. All right, any questions on this so far? Okay. All right, so once you compute taxable income, to compute the amount of taxes that you pay is just multiplying a certain percentage off of that taxable income. Okay. Okay. And so the tax rate is given by some percentage. Okay. And so, I know it's different nowadays. The tax rules typically change, with the administration. And so whoever's president at the time will usually change the tax code to some degree. But, just for simplicity and, just so I don't have to change my notes, for most of this section, we're going to assume a tax rate of 21%. Okay. Okay. And that 21% is for the federal government. Okay, so that's going to Washington D.C. basically. Okay. There are such things as state taxes, and actually, for anyone that works in California, we do pay additional taxes on top of that. And so in addition to the 21% that we pay to the federal government, as part of living in California, we also pay a certain percentage of our income to the state government as well. Okay. But we'll talk about state taxes kind of once we get there. Okay, and so to kind of illustrate this, just a very simple example, let's just kind of see all of this in action. Okay, so let's consider the following cash flows for a company. Okay, and this will be cash flows over a 3-year period. Okay, so I'm gonna organize it into a table. And so we'll have year 1, year 2, and year 3. Okay. All right, so first thing we'll list is the gross income. Then we'll list all of their operating costs. And so first we'll consider labor. Then materials. And maintenance. Okay. All right, and so I kept the numbers low for this just for simplicity, and so you can imagine that maybe this is like the cash flows for like your nephew's lemonade stand or something like that. Okay, and so let's say that in year 1, and so let's say that the company made $9,000 in year 1. Okay. That's pretty good for a lemonade stand, actually. Maybe that's not a good example. Okay. And then year 2, let's say that they had a little bit of a better year, and so they made $9,500 in year 2. And then year 3, they've made $8,500. Okay. Okay. And year 1, let's say they had to spend $2,500 on labor. Okay, so that's paying their employees. And so year 2, let's say they spent $3,000. Okay, in year 3, they spent $3,500. For materials, year 1, let's say they spent $500. Year 2, they spent $750. Year 3, they spent $400. And then for maintenance, let's say they spent $350 in all 3 years. Okay. All right, so this is kind of the financial report for this company. Okay, so we know already just how much money they've made each year, as well as how much money they spend to kind of operate their business on a day-to-day basis for that entire year. Okay. All right, so for this problem, let's assume a tax rate of 21%. Let's do 2 things. And so for each year, let's compute the taxable income. Okay, so how much of their income are they going to get taxed on? Okay. As well as how much taxes that they owe each year. Okay. All right, so let's start with taxable income. And so remember, taxable income, the way that we compute it is we take the gross income that the company's made, and then we subtract out all of their kind of necessary expenditures. Okay. We're not talking about any depreciation yet, so these are just kind of all the ordinary and necessary expenditures. Okay. And so all of the costs here are considered to be necessary, right? And so to run a business, you need to pay your employees, you need to pay for all your raw materials, and you also need to pay to maintain your equipment as well. Okay. And so all of these kind of fall into that category. And so let's go ahead and compute that. And so for year one, our taxable income is going to be 9,000. Okay, so that's how much money the company made. We're going to subtract out the labor costs, and so we're going to subtract out 2,500. We're going to subtract out the material cost, and we're subtract out the maintenance. Okay. And so we perform all that arithmetic, and we get a taxable income of 5,650. Okay. Remember, the reason we're subtracting all these is that these are all the ordinary, necessary expenditures. Okay. And so out of that $9,000 that the company made in year one, they're only going to get taxed on 5,650 of that. Okay. Okay. So let's go ahead and repeat the calculations for year two and year three. Okay, so year two, they made $9,500. They paid $3,000 in labor. They paid $750 for raw materials. And they paid $350 for maintenance. And so we perform that arithmetic and we get 5,400. All right, and then finally, year three, we have 8,500 minus 3,500 minus 400 minus 350. And so our taxable income in that last year is going to be 4,250. Okay. Okay. So now that we have the taxable income for each year's, the taxes paid can be very simple. And so, we know the tax rate. So the tax rate is 21%. And so all we have to do is take 21% of the answers that we got in the previous step. Okay. All right. And so in year one, we had a taxable income of 5,650. Okay. We're going to multiply that by 0.21. And if we do that, we get 1,186.5. Okay. And so in year two, we get 5,400. That was our taxable income. And again, we multiply that by 0.21. We get $1,134 and no cents. And then in year three, we had $4,250. That was our taxable income. We multiply by 0.21. We get $892.50. Okay. All right, so fairly simple. And so, income taxes, work a bit different than sales taxes. And so I think, we're all kind of accustomed to sales taxes just being a percentage of, the amount of money you paid at the store. But income taxes, you kind of have to have this distinction of, how much the gross amount of money that you made, and then the actual taxable income, which is obtained after you subtract out all of the expenditures. Okay. Okay. Any questions on this? Okay. All right, and so that's kind of the basics of tax calculations. Okay, so we're going to be kind of playing this game, for the whole week. Okay, except we're going to throw some additional wrinkles into this process here. Okay, so let's start with the first wrinkle. So let's start talking about state income taxes. And so, probably as you're already aware, even though, our government system here in the US is quite complex, it's very complex. And so, we have kind of multiple levels of government. And so at the very top, we have the federal government. And so the federal government kind of oversees the entire country. But kind of right below that, each state, one of our 50 states here in the US, they have their own government that they kind of operate, not totally independently, but largely independent from the federal government. Okay? And of course, there's a lot of intricacies in how those interact. But basically, just for the sake of tax calculations, you can assume that your state government is kind of a separate entity from the federal government. Okay. Okay. And so why that's important is that some state governments will also levy some income taxes on their citizens. Okay. Okay. And so it's important to know that these state taxes are on top of what the federal government is already imposing. Okay. And so, I think this distinction is important. And so even though, they're all part of the government, it's just that, your state is operating with a different amount of money in a different pot rather than the federal government. Okay. So that's why your state government, they can impose income taxes on top of what the federal government already charges you. Okay. And so I say some state governments here because not all states will charge income taxes. Unfortunately, we live in a state that does charge income taxes, and so California actually is one of the highest states that has the highest kind of state income tax rate. Okay. And so luckily, the state income tax, even for the highest states, is still much lower than the federal government. And so just to give you kind of a sense, California is one of the highest, if not the highest. I think it may have changed recently. But California imposes somewhere between 6% and 10% of taxes on top of the federal income taxes. Okay. Okay. And the exact state income tax that you pay in California depends on your income. And so higher earners will get paid or will have to pay higher amounts of state income taxes. Okay. All right. But one of the nice things is that, or at least one of the nice features of our tax code is that, what the federal government says that any amount of taxes you pay to your state, you don't have to pay those same taxes to the federal government. Okay. In other words, what you can do is that your state income taxes will count as a deduction that you can take off from your federal taxable income. Okay. Okay. And so that's just so that you don't have to pay taxes twice on the same amount of income. Okay. And so kind of the way that I kind of visualize it in my head is that you get your paycheck. Okay. The first thing that happens is that the state is going to take their cut, and so the state is going to take their whatever 7-8% tax rate. Okay. And then just on whatever's left, then the federal is going to tax you on just whatever's left after that. Okay. Okay. And so to kind of illustrate this, let's do an example. Or first, are there any questions on this? All right, so let's do an example just so you can see how this is. Okay. And so in this example, let's say that we are working for a small engineering design firm in Pennsylvania. Okay. Pennsylvania is another state that charges state income taxes. Okay. And so let's say that after they've subtracted their ordinary necessary expenditures, and so they've already subtracted their labor, they've already subtracted their raw materials, all that stuff, then they have a taxable income of $100,000. And so if we assume that Pennsylvania, let's assume that they have a state income tax rate of 10%. Let's compute how much taxes they pay to Pennsylvania and how much taxes they pay to the federal government. Okay. Okay. All right, so we're starting with the pot of $100,000. Okay, so that's they've already subtracted all of their necessary expenditures. Now it's time to compute taxes. Okay? And so the first thing we're going to do is compute the state taxes, right? So remember, states take their cut first. Okay, and so if we have a state income tax rate of 10%, that means we're going to multiply this by 0.1. Okay. And so we take 100,000 multiplied by 0.1, and we get a state tax amount of $10,000. Okay. And so out of that $100,000, this company has to pay $10,000 to their state government. Okay, so now we have now let's go ahead and compute the federal taxes, right? So remember, we've already paid $10,000 in taxes to the state, and so we're not going to pay taxes on that again. And so we're going to take 100,000. We're going to subtract 10,000, okay? Because that's taxes that we've already paid. Okay. And then what we have left is 90,000. And so we're only going to get taxed on that 90,000 for the federal taxes. Okay. All right, so we take that 90,000. Okay. We multiply by the federal tax rate. So the federal tax rate is 21%. Okay. And so we take 90,000 multiplied by 0.21. And what we get from that is 18,900. Okay. And so if we want to compute the total number of taxes that we paid, we take, we take the state income taxes, 10,000, we add it together to the federal taxes, which is 18,900. And then from that, we get 28,900. Okay. And so, that is a bit better, because if you just simply add the tax rates together, and so you add 10% and 21%, you would get a 31% total tax rate. And so if you just take 31% out of your out of the $100,000, you would pay $31,000 in taxes. And so the fact that you can deduct state taxes away from your federal taxable income does end up saving you a bit of money. Okay. All right. Any questions on this? Okay. All right. And so there's that's kind of the basics of taxes and doing deductions and computing your state and federal. Okay. Now let's move on to a topic that is particularly relevant to a lot of engineering companies, which is depreciation. Okay. Okay. All right. And so the idea with depreciation is that, for a lot of, and this goes beyond just engineering companies, but, for a lot of companies in general, they have some additional expenditures beyond just their day-to-day. Okay. In particular, one thing that a lot of companies have to buy is that they have to invest in usually very large pieces of equipment, or they have to make very large purchases to run their company. And so think of some of the examples that we've talked about in this class already. And so, if you're a power producing company, say you're Southern California Edison, maybe you might invest in some pumps, you might invest in some solar panels, right? And so these are very large pieces of equipment that don't just kind of go away after immediately. Okay. So all the expenditures that we've talked about so far, so things like labor, things like raw materials, things like maintenance costs, okay, this is kind of money that the company has to spend, and then they just kind of never see it again. It kind of gets used up immediately, right? And so you buy, let's say that you buy a piece of wood, okay, and then you use it and you sell it, that wood has no more value to you because you don't own it anymore. Pieces of equipment are different, and so usually you buy a piece of equipment and then it lasts you for quite a long time, so usually several years. And so and so the rules that we use to deduct large equipment costs are different than day-to-day expenditures. Okay. Right. And so let's say for a simple example, let's say you own a delivery company, right? And so to run your delivery company, you have to buy trucks, right? You buy things to actually, vehicles to actually deliver your products. And so that truck, you're going to buy that in 1 year. You don't use up the truck all in 1 year. And so you use it for, 5, 6, 10 years, right? And so when you're computing your taxes for that year, you're going to have to play by some different rules. Okay. And kind of the reason for this is that, when you buy a large piece of equipment, year after year after year, it still retains a large part of its value. And so, you're not really using up the entire cost. You're only using up a portion of the cost each year. Okay. And so another way that we can say that is that when you buy a piece of equipment, its value, instead of being used up immediately, it kind of just slowly decreases with time. Okay. Okay. And so the idea with depreciation is that the amount of money that you can deduct from your taxable income for a large piece of equipment should only be the amount that you lose value on that piece of equipment. Okay. Okay. So let's give an example. Okay. It's very, very simple. And so, let's say, and so, anyone that owns a car knows that, or you bought a new car, as soon as you drive it off the lot, as soon as that wheel touches the street outside the dealership, you probably lost like a good 20% of the value of your car. Okay. Okay. And so let's say that you purchased a car for $25,000. Okay. So that was kind of the initial value of the car. And so you you use the car, for a year. And so after a year, just for simplicity, let's say after a year, the car is now valued at $20,000. So you go to Kelley Blue Books, and so you look up your car, you enter your mileage and everything, and Kelley Blue Book says that you can sell it for $20,000. Okay. And so during that time, during the course of that year, what you can say is that the car has lost $5,000 of value, right? Okay. Or in other words, one way that we could say this is that the car's value has depreciated by $5,000. Okay. And so now let's consider the situation where you use this car to run your business. Okay, so let's say that you're an Uber driver, you're a DoorDash driver. Okay, so your car is an important piece of equipment for you to actually make money, and so you can actually use that to deduct some of your car's purchase from your taxes that year. Okay. Okay. And so that fact makes sense, right? And so, everything we've talked about up to this point is that, any cost that you incur to run your business, you shouldn't have to pay taxes. Okay. And so the question here is that, if you're going to deduct, and so let's say you're doing your taxes for that first year. So you bought the car, you used it for a year, and now it's time to, do your taxes for the year. How much money can you deduct from your taxes? Okay. And so on the one hand, you purchased this car this year for $25,000. Okay. Right. And so that happened, right? You have the receipts, you actually purchased that car. But, you're still going to continue using that car, in the future, right? So it's only been a year. And so, you can still use that car, for hopefully many years after this. Okay. And so the other way to look at it is that, instead of deducting that the whole $25,000, the government will only let you deduct $5,000 of the car. Okay. Right. And the reason for this is that this is the value of the car that was lost in that 1 year. Okay. And so when you go to do your taxes, you'll only be able to deduct $5,000 worth of from your income. Okay. ideally, it would have been great to deduct the entire 25,000, right? And so, let's say that you earned, let's say that you earned $100,000 that year, okay? And so if you deduct $25,000, that means you would only pay 75, you would only pay taxes on $75,000 of your income, okay? And so generally speaking, it's more desirable, it's more desirable to deduct as much as you can from taxes, from your taxable income, okay? Okay. Because the more deductions you do, the less taxes you have to pay, which is good. And so, if it were up to the citizens, if it were up to the people, we say that, hey, we purchased this car for $25,000, right? And so, I don't want to pay taxes on that 25,000, but the government's like, hold on, wait a minute, you're still going to use this car after this. And so the car only lost about $5,000 worth of value. So that's the only amount that they're going to let you deduct from your taxable income. Okay. And so depreciation is kind of, I think it's a little bit of a confusing concept at first to grasp, because I think on the one hand, we have this idea that you buy a large piece of equipment, you buy a large capital purchase, of course, that's going to decrease in value over time. But then, to link that together with taxes and what that really means, I think is I think it's a bit, it takes a couple times to really understand that. But so this example here actually isn't in the notes, but I kind of came up with it just now. So hopefully, that kind of makes it clear about, why we use depreciation and, why it's kind of a big part of our tax code. Okay. All right, any questions on this? Okay. All right, and so let's I'm going to give you kind of a visual kind of a representation of depreciation. Okay. Okay. And so if we make this graph here, we're on the x-axis here, we have time. Okay. And on the y-axis here, we have the value of an asset. Okay. And so if we consider time 0, we always know that this is the point at which the asset has its maximum value. Okay. Okay. And so the highest value that a piece of equipment will have will almost always be the price that you bought it at. Okay. And then over time, let's assume a very linear kind of depreciation, that value is going to decrease with time. And so, I'm going to make a couple of dotted lines here to kind of represent, each of the years. Okay. And so over many time periods, the value is going to go down, okay, until it reaches its final value. Okay. And this final value for the asset is something that we're actually familiar with. So we've actually used this in our calculations before. Okay. And so the final value for the asset, up until the point where you sell it or you get rid of it, that's the salvage value. Okay. And so remember, that's something that we've used in a lot of our calculations. Whenever we buy a piece of equipment, for a lot of them, we assume that we can sell it at some point at the end of its life. We sell its parts, and then that's what gives us the salvage value. Okay. And so with this graph, you can kind of see that the decrease from the initial value, the initial cost to the salvage value, is usually a steady decrease. Okay. And so for tax purposes, each year, what you do. So let's say that we're considering the taxes at the end of year 2. Okay. And so this kind of vertical distance right here, this represents the amount of value that the asset lost. Okay. And so that's the amount that the asset depreciated. And so that's the only amount that we can deduct from our taxes. Okay. Okay. All right. So let me give you kind of one more definition. And so, you know, what this graph is showing you here is the value of the asset over time. And so we actually have a term to give the current that defines the current value of an asset, and that's called its book value. Okay. So that's just kind of a visual representation of you know, of depreciation. All right, any questions on this? Yeah.
So if the car depreciated again the second year, will you able to write that or deduct that from your taxes?
Yep. Yep. So each year, basically each year, you're going to compute how much value your asset lost. And so, you know, for the second year, you know, you'll start, you know, let's say you start from 20,000, and then let's say the car's value dropped to 13,000 at the end of that second year. And so the amount that you can deduct from your taxes is 7,000, which is the difference between the starting value that year and the value at the end of the year. Okay. And so this graph here, you know, we have kind of a steady decrease from, you know, from the initial cost to the end. Okay. And so this is kind of the simplest, I call it a depreciation schedule for an asset. Okay. And so a depreciation schedule, basically this defines how the value of an asset will decrease over time. Okay. Okay. And so the depreciation schedule that I have in the graph above, that's known as straight line depreciation, or in other words, you know, we just have a straight single line with a constant slope from the initial value down to its salvage value. Okay. There's other forms of depreciation schedule. I don't think we're going to get to them today, but just know that, you know, every asset is a little bit different, and so, you know, how the asset kind of depreciates in value, you know, it depends on the asset, and honestly, it kind of depends on the tax rules at the time. Okay. And so at the time, you know, when I wrote these lecture notes, you know, there were several different depreciation methods out there that's used in the tax code. Now I'm actually not sure what the Biden rules are. But I remember what the Trump rules for the depreciation schedule was. And so we'll talk about that when we get there. But I want to cover, you know, the four different main methods that you can use to compute depreciation schedule. Okay. And so straight line is the first one. The second one is called declining balance. The third one is called bonus depreciation. And the fourth one is called modified accelerated cost recovery system, or MACRS. So we'll go through all four, but I think we'll just have time for the first one today. Okay, so let's go over straight line depreciation. All right, so under straight line depreciation, you know, the way it gets its name is that the asset's value depreciates in a linear fashion. Okay. Or in other words, the asset loses a fixed amount of value each year. Okay. All right, so the formula for straight line depreciation is the following. Okay. And so we're going to take B minus S and divide it by N. Okay. Where B here is your initial cost. S here is the salvage value. And N is the useful life of the part. Okay. Okay, so you basically just take the initial cost, you subtract the salvage value, and you just divide it by how long or how many years the part is going to last. Okay. The reason we use B is that B is like buy, and so that's how much you buy it for, and S is kind of like sell. So you take the buy price minus the sell price divided by N. Okay. Okay. So let's do an example with straight line depreciation, just so that you can see how depreciation factors into our calculations. All right. And so let's say that a shipping company recently purchased a new truck for $50,000. Okay. And so this truck, you know, the company expects to use it for 5 years, and each year that individual truck is expected to produce $20,000 in revenue. Okay. Okay. And so at the end of the 5 years, the company plans to sell it, and then they expect that they could sell it for $10,000. Okay. Okay. All right. And so if we assume, let's assume an interest rate of 10%. Okay. And let's also assume a federal tax rate of 21%. Okay. we want to compute the present worth of this purchase, and we're going to do it in two different ways. And so the first way we're going to do it is the same way we've done it before, and so we'll call it the before tax present worth, and then we're going to compute it using after incorporating taxes, which will be the after tax present worth. Okay. And so, of course, we have to use some depreciation in this case, because the truck is going to be used for 5 years, and the depreciation method we're going to use is straight line. Okay. Okay. All right, so let's start with before tax, because we've done that before, and we can actually do this in one line. All right. And so we have all the information we need to compute the before tax present worth. And so we have all the cash flows, and we have the interest rate. Okay. It's a before tax or present worth is going to be. First, we have the purchase price of the truck. And so that's going to be a minus $50,000. Then we have the revenue. So the revenue here is 20,000. And of course, because it's a revenue that takes place at the end of every year. And so that's a uniform series. And so to convert that to present worth, we're going to need a P over A conversion. So we have a plus 20,000 P over A. Our interest rate is 10%. And our number of time periods is 5. Okay. And then we have the salvage value. So the salvage value is going to be P over F, 10%, and 5. And so if we look up these in the compound interest table, what we get from everything here is a positive $32,000, $32,029. Okay. So the before tax, that's just nothing different about that. We've done that all before. So the reason I'm doing this is so that you can have a comparison, and so you're going to see just how big of an impact taxes are going to make. Okay. Okay, so let's do the after-tax calculation first. Okay, or after-tax calculation now. Okay, so for these tax calculations, for this one, it's not going to matter too much, just because we have a fairly uniform cash flow here, and we have straight line depreciation. But what you'll see is that for a lot of tax calculations, the best way to kind of tackle it is by making a cash flow table. Okay. So we touched on that, earlier this semester. And so, now you're going to see kind of a practical implementation of it. Again, it's not going to be, you might think it's kind of a waste of time for this one, but once we get to some of the more complicated depreciation methods, the table is kind of the only way you can really organize it. Okay. All right. So we're going to be making a table, but the first thing we need to do is we need to compute how much we're deducting for depreciation each year. Okay. And so let's use our formula up here. And so our formula is B minus S divided by N. Okay. And so our B here is 50,000. That's how much we bought the truck for. Then we subtract 10,000. Okay. Because $10,000 is the salvage value. And then we're going to divide it by 5 years. And so our straight line depreciation is 8,000. And so each year that we're going to use this truck, the truck is going to lose $8,000 of value. And that's the amount that we can deduct from our taxes. Okay. So let's go ahead and set up a table. All right, so our first column here will be for the year. Okay. Okay. And I'm going to make a row for each year starting at 0. Okay. Okay. Our next column is going to be one for before tax cash flow. Okay. Our next column is going to be the amount of value that we're going to depreciate that year. Okay. Then we're going to compute the taxable income for that year. So how much of our income we're going to get taxed on. Okay. Then we have our taxes column. So that's how much taxes we're going to pay for that year. And then our final column here will be the after-tax cash flow. So after we pay taxes on for that year, how much money do we actually get left over? Okay. So first we have year 0. And so year 0, that's present day. And so that is when we purchased the truck. Okay, so we purchased the truck for $50,000. Okay, so we have a minus $50,000 on year 0. And we don't pay any additional taxes on top of that. Okay, so we're going to assume that the $50,000 we paid to the dealer, that already included the taxes, and so we don't have additional taxes to pay. Okay. So that's pretty typical. So for these tax tables, you're going to start on year 0, just so that you can see the initial cost. And so you're going to leave the rest of that row blank because, a lot of that stuff isn't going to be applicable to that first year. Okay. Or that first time or the first row. Okay, so now we come to year 1. And so this is at the end of year 1. And so we know that from the problem that each year, the truck is expected to generate $20,000 of revenue. Okay, so that's before we pay any taxes on that. The truck has produced $20,000. Okay, so that's going to be our before tax cash flow. Additionally, in that year, we use the truck for a year. Truck has lost $8,000 of value. Okay. And so our taxable income for that year is going to be the difference between the amount of money that we made, which is 20,000, minus the depreciation, which is 8,000. And so that year we're only going to get taxed on $12,000 of our revenue. Okay. Next, we're going to compute the taxes. And so the taxes from that first year is going to be 21% of 12,000. And so that's 2,520. Okay. Okay. And then our after-tax cash flow, what we're going to do is we're going to take our before-tax cash flow and subtract our taxes from that. And then we get 17,480. Okay. Okay. All right, so that first row is an example of how you factor taxes into your calculations. Okay, so just like we did earlier today. And so we took the amount of money we made that year, we subtracted, you subtract it from that. And so remember, you don't get taxed on the entire thing. And so in this case, we subtract the depreciation charge. Okay. And so we only get taxed on 12,000. And then whatever we get taxed on, we subtract that from our before tax cash flow. Okay. All right. And so, I'm going to go stop here for now just because it's almost 2:15. And so we'll go ahead and fill in the rest of this table on Thursday. Okay. So, as we wrap up, are there any questions on this? Okay. All right. So that's all we got time for today. And so I'll finish up this example on Thursday, as well as talk about the rest of the depreciation methods. I'll have your midterms graded by Thursday as well. And so, I'll bring them to class. And so, if you want to come here on class on Thursday, you can pick up your exam. If not, I can hold on to it whenever you come by. Okay. So have a great rest of your day, guys. Thank you guys for coming, and I'll see you on Thursday.
Is it possible for your asset to appreciate? You have to pay taxes on how much it appreciates.
It can. Yeah. Yeah. So we'll mention that briefly next time, but it's rare. And so
Okay.
that happens mostly for it happens for stocks. And
That's
so,
what I was thinking.
and so for stocks, you kind of pay, they call that capital gains, capital gains tax. But it also can happen for like collector's items too. So a lot of times, and it's becoming a bigger thing now where you buy something and then, maybe like a Pokemon card or something, you hang on to it for like 20 years and then it's going to gain a ton of value. And then once you sell that, then you pay tax on just whatever value that it increased to.
Okay.
Water class?
Would it be like the same for like this is like way like NFTs, because don't they like appreciate with value?
I
But I think
would
that's
think
a
so.
whole
Yes,
different-
it's a whole different thing. I think they're still trying to figure out how they're going to tax those things.
Okay.
I think just for kind of, I think they would tax them very similar to like stocks.
Okay.
Yeah.
Thank you.
Yeah. Mhm.
You know, what's funny is, I heard that it used to be up until somewhat recently that in the South, all the people that bought supercars like Lamborghinis and Ferraris,
Yeah.
would register an LLC in Montana and pay zero taxes
Yep.
on purchasing them.
Yep.
And it got to the point where, some of the state legislature in Georgia, I heard, were like talking